All right, you know the drill. Every year, it's that same mad dash, waiting for all those tax forms to pop up in your email or your mailbox. You got your W-2s, your 1099s, and we're all kind of trained to think that what we get on paper is what we have to report. But what if I told you the real risk is in the forms you don't get?
It seems like such a simple question, right? But the answer, well, that's where things get really interesting. And it's right at the center of some huge changes happening in the tax world. So let's bust a few common myths that could save you a massive headache with the IRS.
Okay, let's start with the big one, myth number one. This is the idea that if you don't get a 1099 for some work you did, that money is just off the books, a free pass, right? Yeah, well, as you're about to see, the IRS has a very different take on that. For over 70 years, I'm not kidding, since 1954, this has been the magic number. If a business paid you, as a contractor, $600 or more, they had to send you a Form 1099 NEC. Just think about that for a second. A number that has never, not once, been adjusted for inflation. But that is all about to change.
So, what's causing this big shakeup? It's a new piece of legislation called the One Big Beautiful Bill Act, or OBBA for short. And this law is really aimed at making life easier for businesses, especially with the explosion of the gig economy. It's making some major tweaks to those rules that have been around forever. So let's just walk through this timeline, because this is a huge deal. For payments made in 2025, it's business as usual. That threshold stays at the classic $600. But then, bam, for payments in 2026, it jumps all the way up to $2,000. And starting in 2027, that $2,000 is finally going to be adjusted for inflation. We are talking about the threshold more than tripling. And this, right here, is the absolute key. This new law is a break for the business that's paying you. They get to send out fewer 1099s. But for you, the freelancer, the contractor, the person who got the money, absolutely nothing changes. If you earn, say, $700 in 2026, you might not get that 1099 form, but that income is still 100% taxable. And hey, don't just take my word for it. This is a direct quote from IRS guidance. It doesn't matter if you get the form or not. If you earn the income, you're on the hook for reporting it. It just goes to show the real responsibility has always been on you, the taxpayer, to keep your own accurate records.
You know, this whole idea of off-the-books income leads us straight into our second big myth. And this one feels almost ancient, this idea that you can just swap services or goods and it's all tax-free. You know, a friendly trade, no harm, no foul. The IRS, well, they have a less friendly name for it, the underground economy. And look, this isn't some new obsession for them. The IRS has been laser-focused on bartering for decades, seeing it as a huge area for tax evasion. When they see a lawyer and a house painter trading services, they don't see one friendly swap. They see two separate, distinct, and taxable transactions.
So how in the world does the IRS put a dollar amount on these trades? It all comes down to this idea of fair market value, or FMV. And the most important part to remember is that your taxable income is based on the value of what you receive, not what you give away. And that's super important because it stops people from just saying their own services are worth less to lower their tax bill. Let me break it down with a super simple example. Let's say a plumber does $200 worth of work for a dentist. That plumber has just earned $200 of taxable income. Why? Because that's the fair market value of the dental work they're about to get. Then, the dentist gives the plumber a $200 cleaning. The dentist has also just earned $200 in taxable income. See? One handshake, two separate taxable events. Now you're probably thinking, how could they possibly track all this? Well, the IRS has a system for that too. If you're part of an organized marketplace, something called a barter exchange, that exchange is required by law to report the value of your trades to the IRS on a Form 1099-B. So even when no actual cash is involved, there's still a paper trail. This leads us to our third and honestly most fascinating myth. What about time banking? You've probably heard of this. I'll walk your dog for an hour if you help me with my garden for an hour. An hour for an hour. It sounds a lot like bartering, but is it?
Well, this is where the rules get really, really specific.
So here's the deal. Yes, a very specific type of exchange can actually be tax exempt, but it is an incredibly narrow little exception that's carved out in the Treasury regulations. This isn't some secret loophole. It's more like a very thin tightrope, and if you step off it even a little, you're right back into taxable bartering territory.
So here are the three tests straight from the regulations.
To be exempt, the exchange has to be informal, it has to be for similar services, and this is a big one, it has to be non-commercial. If you fail even one of these, the deal is likely taxable.
And this is where you can really see the difference. Trading your professional IT skills for professional dental work, that's a commercial trade of different services, and it's valued at fair market value. That's taxable. But agreeing with your neighbor to trade an hour of babysitting for an hour of dog walking, that's personal, it's similar, and it's non-commercial. That's probably exempt. The IRS draws a really bright line between community helping and professional business.
So, after all that, what's the big takeaway? When you look at these new 1099 rules and the really strict guidelines on bartering, one message comes through loud and clear. At the end of the day, the responsibility for tracking and reporting your income falls squarely on your shoulders.
And always remember, the IRS's definition of income is one of the broadest legal definitions out there. All income from whatever source derived. That includes cash, property, services, even things like virtual currency. If you get something of value, the government's default position is that it's income.
So let's just boil it down. First, keeping good records isn't just a good idea anymore, it's absolutely crucial. Second, those reporting thresholds are changing, but that's a change for the person paying you. And third, your actual obligation to pay tax on what you earn, that remains completely unchanged.
And all of this leaves us with one last big question for the future. We've covered cash, services, and bartering. The IRS has already made it clear that virtual currency is treated as property. So as our economy gets more digital, more decentralized, the lines are only going to get blurrier. The real question is, what will the IRS decide to call income next?